Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video, we are looking at 5 great stocks that are currently being bought by some of the biggest investors in the world. I'm talking about the Warren Buffetts, the Charlie Mungers and Bill Ackmans and all of these hedge fund people. Okay, there's a website where they have to share. So there's a policy from the SEC, okay, SEC, that where they have to disclose the stocks they're buying and selling. But they only disclose it after a couple of months later, I think 3 months or whatever. So there's a website that tracks all of that. I'll share that with you at the end. I looked at it recently. I looked at all the halal stocks in there, and I picked the 5 that I thought are great companies that could potentially be a great addition to our portfolios. I'll share that with you in a bit. But before we do that, let's just have a look at what's happening to my portfolio. Last week, it's been good week, but I was really busy, so I didn't even add any money or bought anything new, didn't keep up with the portfolio. Also, I didn't even do any videos. I was planning to do 2 videos midweek, but I didn't have the chance to do it because work has been really busy. But as you can see right now, we've got about £46,000 in the portfolio overall, so but with a little bit of cash in there, so we've got about 46 and 687 pounds. So it's gone up quite a bit. So from 44.5 to right now £46,000. And that money, actually, this money came from a sale. I took some profit off. I'll share that with you very soon, and why I sold that and let you know. But yeah, this is gone up quite a bit. Like I said, I haven't actually purchased anything new at all. That just one sale that I made. That's about it. And then generally the overall market, it looks like we had a very strong week because of some of the clarity that we received from the Fed, the US Fed, that is. They've now basically said the interest rates will now be 0.25% instead of 2.50. But obviously they potentially might be hiking up again very soon in another couple of months. The next meeting, they'll probably move it up to 0.50. Some analysts are saying it'll probably be about almost 2% by the end of the year, the interest rate. So we'll see what happens. But because we now know exactly how much is going up, the markets have actually done quite well. The situation in Ukraine is still the same, obviously. But yeah, so just yesterday, it looks like the majority of the tech companies, the big boys, had a great day. And then when you look for the week, look at that. Wow. That's amazing. Look at this. Just 1 week. Nvidia is like 20% up. Adobe almost 10%. Apple, Microsoft, all of these. Every single sector is green apart from oil, obviously. Oil's been doing amazing the last few weeks, so I'm not surprised it's gone down quite a bit. But yeah, so generally doing really well. But when you look at it for 1 month, it's a different ball game. Qualcomm, for example, is down about almost 11%, and Mastercards and the Visas, the Disney's down 10%. So yeah, it's mixed. Okay, I don't know if we're gonna continue seeing more green or more red in the next few weeks, but whatever the case might be, I guess, as I always said, invest in great companies with great free cash flow and hopefully pay you some dividends while you wait in the stocks to correct. And yeah, just to keep buying your blue chip and yeah, carry on investing. So let's have a look at the 5 stocks that the hedge funds are buying basically that bought in last quarter. And no surprise, the first one they is buying, it's Mastercard. I think there's about 12 different hedge funds that are buying this. Okay, Mastercard is currently trading $350 per share. It has a PE, very high PE, and very high free cash flow, price to free cash flow of almost 40. So it looks expensive. It smells like this is expensive stock. But let's see what the rest of the metrics tell us. EPS is almost $9, which is quite good. Market cap, $341 billion company. It has economic moat. That means it has a competitive advantage over their competitors. Their main competitors is actually Visa, and Visa does more processing, okay, in terms of transactions. I think that's about 10 billion, whereas this 10 trillion, and in 2021, I think it was 2020, But yeah, their main competitors actually, but between the two, they both have a competitive mode and they are monopolizing this market, to be honest. Annual dividend, very, very small, 0.56. 5-year growth rate of 18%, which is really good because hopefully if they keep doing this in the next couple of years, this will definitely obviously increase. Dividend growth strokes about 15 years. Payout ratio, less than 22%. The reason we're focusing on this is because the company, if they pay in only 22% of their net profit as a dividend, then that means they have a room to improve. If a company is paying almost 100, then they might start cutting it down. That's one of the reasons why we have payout ratio, which is quite good. Dividend safety, 99%, because of this reason, okay? Because they still have a room to improve, and then they can even go up to 50%, okay? Then still be able to pay this. Free cash flow right now is $8.6 billion in the bank. Beta is slightly volatile, so above 1. We're looking for something below 1, but this one is above 1. Current ratio, we're looking for above 1 because that means in the next 12 months, they should be able to pay their, if something happens to the company, they should be able to pay any of their debts. Profit margin, absolutely amazing, 46%. This is why this stock is super expensive, okay? 46% profit margin, return on equity, 125%, growth rate. So quarterly revenue growth year on year is 27%, and the quarterly earnings growth of 33%. Then you've got the next 5 years. What are we expecting? We're expecting the earnings growth of 25%, which is absolutely huge, okay? And that's the reason why this stock is priced very high, okay? And then when you look at simply Wall Street, we're looking about 15% undervalued at the moment. They're saying price should be about $408 per share, currently $350, and it is a buy, okay? According to Morningstar, it's fairly valued, 369. Like I said, it's about 350 right now, so it's a little bit room for improvement. Tip ranks, on the other hand, is saying it should be $431 per share, and it has about 23% upside if you bought it now. This is one of the stocks that the big boys are buying right now. The next one they're buying is, no surprise, again, Visa. Okay, and like I said before, it processed over $10 trillion okay, in 2021. Okay, we're still waiting for 2022 fiscal year, obviously, so that's the reason. When you look at the price, is $219 per share, PE of 43, so it's slightly higher than Mastercard right now, but price to free cash flow is actually only 34, so it's just, at least seems cheaper when you use a price to free cash flow here. Okay, EPS $5, and then you've got market cap of $460 billion. Obviously it has a wide moat, and then we've got annual dividend yield of almost 8%, and the 15 years or 15%, sorry. Oh, this should be so 5-year growth rate of 15%, according in comparison to Mastercard, that they are 18%. So slightly, Mastercard basically grows their dividend slightly higher, but again, it's great company. Obviously, it's similar in terms of what they pay overall. Basically, what they pay is very similar. And then you got 14 years of paying that dividend, increasing that dividend. Payout ratio only 22, so very similar to Mastercard. Dividend safety, basically 99%. That's the highest you can get, basically. Free cash flow, $15 billion in the bank. Beta is slightly lower than Mastercard. Current ratio of 1.39. This tells us they have got enough in the bank to pay off that their debt in the next couple of 12 months. Profit margin of 52%, return on equity of 36%, quarterly revenue growth a year on year of 24%. Then you've got quarterly earnings growth, okay? That's so top line and bottom line, both of them growing. And then for the next 5 years, the expectation is about 18% growth in earnings. According to Simply Wall Street, it's about 22% undervalued at the moment. The price should be about $255 by the end of $255 per share by the end of this year. Okay, so right now we're looking about $219. In fact, it was below 200 about just a week ago, I think, this time last week. It's the buy at the moment, according to Morningstar, is basically 10% discounted at the moment, and that is $221 per share. That's what they're predicting. According to Tip Ranks, $273 per share, and that is 38% upside if you were to purchase this stock right now. Right, so that is the two big boys right now in terms of transactions. Okay, Mastercard and Visa. The big boys, the next stock the big boys are buying is this stock here, Intel. Now you might think, why on earth are we buying this company? Right, there's a couple of reasons why this Intel is actually quite attractive right now. We'll look at the valuations in a second, but when you look at the future, if you're thinking about, say for example, right, 5 to 10 years from now, where will Intel be? I think it will go back to where it was, even better, because they have a lot of money. They now is basically doing, they're building a new factory in the US. I think they've got 2 in the US coming up. They're spending over, I don't know, 20 something billion dollars for that reason. Okay. So I genuinely think, and because it was what's been happening recently in China and Taiwan, in Russia, whatever, I'm sure the US will put a lot of money behind this company to make sure it goes back to where it was. Because right now, their main competitors is Samsung and Taiwan Semiconductor. Both of these companies are not US based. So the US, actually, Joe Biden actually met with the CEO of this company recently to discuss the shortage in chips and so on. And that's one of the reasons they've actually been given a chance to obviously build those factories and so on. So I think if you're looking from 5 to 10 years from now, and if you are a dividend investor, you wouldn't mind actually earning this company, get some dividend while you wait, and then just by the time you get to, say, 5 years from now on, the price might be about, say, I don't know, $100 per share or whatever. You might double your money. And this is one of the reasons probably they're buying it, but they might have other reasons. Okay, so right now, looking at this stock right now, it's trading $47 per share, and PE only 9. Okay, just about 10. Okay, price to free cash flow is slightly higher. So when you look at price to free cash flow, it's not that cheap. So you're looking about almost 20. EPS $4.86, 86 pence. Market cap of $192 billion. So it's a huge company if you think about it. They do have economic mode. They pay dividends as about more than 3%. 5-year growth rate of only 6%. Dividend growth streak of 23 years. They have been increasing their dividend. Payout ratio only 25%. So 25% to me means basically you getting this 3% in the next few years, and that's definitely safe. You don't have to worry about it. Okay, dividend safety 80%, free cash flow of $9.6 billion, almost $10 billion there in the bank to pay you and buy back shares, do whatever else they want to do with it. Look at this beta and how basically this company is basically in terms of volatility. They're not very volatile at all. They have current ratio above 2, which is great. So that means they've got enough money. So they have less debt basically. Profit margins of 25%, return on equity of 23%. Now, this is where the issue starts, okay? So when you look at basically where we are now, or when we're heading in terms of revenue, in terms of earnings, it doesn't look great because they missed a few deadlines when it comes to producing certain chips, right? So revenue is only about 3% for year on year. Quarterly earnings growth was basically minus 21%. But for next 5 years, they're expecting the earnings to grow to about 3%, 4%, whatever. Okay. And if you're willing to wait and get that 4% growth as well as the 3% dividend, and that's better than actually inflation. So it's fine. Valuation right now, according to Simply Wall Street, okay, it should be almost 80% undervalued. Their price target is $225. I don't know if they made a mistake, okay? I just don't believe this at all. To me, right, so in my opinion, right now, this stock, if you own it already, then hold it, okay? if you're willing to wait for the next 5 to 10 years, right, then, and you know the company is going to be around and you believe the story, then it's a buy. Okay, I wouldn't sell at all. If I own this stock right now, I would have basically just hold on to it. Okay, if you can average it down, then do it. Otherwise, just hold on to it. Hold on to it. Okay, right now, according to Morningstar, is 27% discounted, and its price should be about 65. Okay, this is more realistic to me than actually 225. Again, tip rank is quite similar, 53, so it's about 13%, 14% upside. So I like these valuations here than this one here. Okay, I'll be honest with you. And if you own it already, maybe hold it. If you thinking of buying it, maybe if you're willing to wait for the next 5 to 10 years and you're long-term investor, then it might be a good idea to look at this company. The next company they are buying right now is Stryker. Stryker designs, manufactures, and markets loads of medical equipment. Okay, including consumable supplies and all sorts of things, and they are very similar to, I believe, Medtronics. Okay, they are in similar sort of markets. So yeah, that is in a nutshell what the company does. If you want to find out a bit more, maybe just look at their last couple of years statements, like things like the 10Ks and so on, to read through and what they do and how they make their money. Currently trading $267 per share, PE of 51. Okay, the sector is only 24, so it's really, to me, it seems really expensive. I'm not sure why they're purchasing this. Let's see if there's anything else in here. Price to free cash flow here is about 36. Again, according to that, it's very expensive. EPS of $5, market cap of almost $100 billion. They do have economic moat. Okay, dividend yield is only just above 1%. 5-year growth rate of an 11%. Dividend growth streak of 30 years. So this is a dividend aristocrat. That means a company that pays their dividend 25 years or more. Dividend safe payout ratio only 28. Dividend safe to 90%. And then you've got free cash flow here, $2.7 billion. Beta just below 1. Current ratio 2.2, which means they have got enough money to pay their debt and so on in the next 12 months. Profit margins of 12%, which is decent. Return on equity 14%, again decent. Return quarterly revenue growth year on year is 10%, decent again. Quarterly earnings growth of year on year and 16%, that's really good, 16.5. And then they're expecting the earnings to grow 11% next 5 years. According to Simply Wall Street, it's 33% overvalued. The price tag should be $198 and currently is $267 per share. According to Morningstar, it's 35% premium right now. It should be $195, so they're kind of similar what they're looking for. Tip rank slightly bit more bullish, so they're saying 7% upside. The price should be $285 per share. So this is another company they're buying right now that's Sharia compliant. The final company they're buying is Microsoft. We all know about Microsoft. We talk about it a lot, so I'm going to give you much of details, but here let's have a look at quickly. $300 per share. P is quite high at the moment. The sector is about 30, so in comparison to the sector, it's not that bad. Price to free cash flow, again, quite high. And EPS, about $10 almost. Market cap of $2.2 trillion. Economic moat is wide. They have a wide moat, so that means competitive. They have competitive advantage. Dividend yield, I wish this was above 1. Hopefully in the next couple of years it will be, if they carry on increasing it, this percentage over the next 5 years. And then you've got dividend growth streak, so 15 years, and payout ratio of only 27%. So they have a room to improve, room to basically grow this dividend hopefully in the next few years. Dividend safety 99%, and free cash flow of almost $61 billion. Okay, they've got to spend on buying back shares, paying off debt, buying other companies, increasing the dividends, however they want to do with it. They've got that much money in the bank right now. In terms of beta, it's not as bad as the other tech companies. Account ratio above 2 obviously is really good. Profit margin, look at this. This profit margin, 39%. Return on equity, 49, almost 50%. Quarterly revenue growth, okay, 20%. Earnings growth of 21%. Next 5 years, about 17% growth. And the valuation is 38. Right now, according to Simply Wall Street, is undervalued by 38%. The price target is $477 per share. Right now it's 300. Okay, to me it's definitely strong buy. And then Morningstar, right now they're saying it's about 16% discounted, $352 per share. It's currently trading 300, so it's got a bit of an upside there. Tip ranks is also the same, 376, so it's got about 26 upside. And again, Microsoft is probably one of my biggest holdings. I think it is the biggest holdings that I have in my portfolio. There we go, about 8.5%. Okay, really great company. I'm definitely holding on to it in the next few years. Now, let me quickly share with you the website that I am talking about. So this website is called Dataroma, and they publish all the investors and people, what they're investing in and so on, like the big boys and what companies they're buying, what companies they're selling. So every quarter they update this. And as you can see here, Amazon, there's 12 hedge funds or whatever big boys, super investors that are buying Amazon. So 12% of them bought Amazon, 11% bought Mastercard, Facebook, Visa, Baba, and all of these other companies. So I looked at this list and I looked at great companies within this list, because you've got companies like Uber, for example, who is still on the growth side, but I'm not really into that at all, so I left those out. You companies like Starbucks, who are not compliant. Yeah, so you've got loads of different companies. You've got Johnson & Johnson, which is one of my biggest holdings in there. You've got Booking, for example, here. What have we got? T-Mobile. We've got Adobe. Okay, again, another great company, really undervalued at the moment. And there are almost about 15 different pages that you can look at. I'll share this on the link so you can have a look at what they're buying. And obviously, you just need to sift through, and like companies like Disney and Goldman Sachs, they're not obviously compliant. So you just need to find out which ones are compliant, which ones are not compliant. And on the top here, if you click Super Investors, you will see basically it will give you a list of the investors. So the Bill Ackmans, Bill Miller, for example, Charlie Munger, there we go. And they will tell you that how many stocks they own, the companies that they own as well. So Charlie Munger, and who is the right man, basically, what's his name? Warren Buffett's best friend, and obviously they both work in the Berkshire Hathaway together. So he owns these 5 different companies. So you can see what they own and how long they've owned and how many shares of that. And so you can just click their names and it will give you the details, any buys, any sales. So it's quite good to basically look at it. But like I said at the beginning, you really need to be careful, because you don't know if they've sold it by then. People like Charlie Munger, actually, he's not like a trader or anything like that, but there's some of them like trade a lot. So they probably sold it by the time you actually found out they've actually bought it. So you have to be careful with that. But yeah, so that's where I got the list from. I'll share that with you. I hope you enjoyed the video. As always, if you like these kind of videos, please like, subscribe, and let me know if you have any questions. Assalamu Alaikum. Take care.